Picture this. It is a Tuesday morning in February. You are sitting at your kitchen table with a cup of tea and a stack of envelopes. You just retired 6 months ago. You did everything right. You saved, you planned, you waited. And then you open a letter from the IRS. It says you owe money, not a little money, thousands of dollars, on income you thought was completely protected. Your hands start to shake, your stomach drops. You think, how is this possible? I retired. I am done working. Where is this tax bill coming from? You call your adult child. They do not know. You call your bank. They cannot help. You sit there alone, staring at a number that does not make any sense. That feeling, that shock, that helplessness is something no retiree should ever have to experience. And yet it happens every single day across this country. Because the moment you retire, 5 major financial rules change. Automatically, permanently, and silently. And most retirees have no idea. Hello, my name is Faria. I am a senior policy analyst and retirement finance expert, and I want you to breathe for a moment, because what happened in that scenario is real, but it is also completely preventable. Today, I am going to walk you through 5 specific things the IRS and federal government treat differently the moment you retire. These are not opinions. These are official rules from the IRS, the Social Security Administration, and Medicare, verified and documented. I am going to explain each one in plain language, no jargon, no confusion, and I am going to give you a clear 3-step action plan to protect yourself starting today. But please, stay with me until the very end of this video, because I am going to reveal one specific mistake near the end that triggers a chain reaction, a cascading tax problem that quietly costs retirees thousands of dollars, and almost nobody talks about it. You need to hear this. So, stay with me. Let me tell you about a man named Robert. Robert is 74 years old. He retired at 67 after a long career as a hospital administrator in Ohio. He was careful with his money his whole life. He had a traditional IRA he had been building for decades. He was collecting Social Security. He had Medicare coverage. By every measure, Robert had done things right. In December of his first year as a retiree, Robert's furnace broke down. It was an old house. The repair was expensive, nearly $18,000. Robert did not want to touch his savings, so he decided to take an $18,000 withdrawal from his traditional IRA to cover it. He figured, it is my money. I earned it. I will just pay the income tax on it and move on. What Robert did not know was what that single withdrawal would set off. First, that withdrawal pushed his combined income over the federal threshold. Suddenly, a larger portion of his Social Security benefits became taxable for that year. He owed more federal income tax than he had planned. Second, because Medicare uses income from 2 years prior to set your premiums, that December withdrawal affected his Medicare Part B premiums 2 years later. Robert's monthly Medicare premium jumped by over $100 a month for 2 full years. Third, Robert had not set up any federal tax withholding on his IRA withdrawals. So all of that tax came due at once in April. 1 decision, 1 withdrawal, 3 financial consequences, spread across 3 years. Robert told his daughter afterward, "Nobody ever told me these things were connected." And that is the truth. Nobody tells retirees how these 5 rules interact until it is too late. So let me tell you now. Here are the 5 things that change, officially, legally, and permanently, the moment you retire. Number 1, required minimum distributions, RMDs. If you have a traditional IRA, a 401k, a 403b, a SEP IRA, or a simple IRA, the IRS requires you to start taking money out of those accounts once you reach a certain age. This is called a required minimum distribution, an RMD. Under the current law, called Secure 2.0, the rules are as follows. If you turned 72 after December 31st, 2022, your RMD age is 73. If you were born in 1960 or later, your RMD age is 75. Your first RMD must be taken by April 1st of the year after you reach that age. Every RMD after that is due by December 31 of that same year. The amount you must withdraw is calculated by dividing your prior year account balance by a factor from the IRS Uniform Lifetime Table. And here is something critically important. If you miss an RMD, if you do not take it on time, the IRS imposes a 25% excise tax penalty on the amount you did not withdraw. 25%. On top of the ordinary income tax you already owe on the withdrawal. Now, two things you absolutely must know. First, Roth IRAs are not subject to RMDs during your lifetime. If you have a Roth IRA, you do not have to take mandatory withdrawals. Ever. Second, those RMD withdrawals count as ordinary income. Every dollar you take out goes directly into your taxable income for that year. And as Robert discovered, that has consequences that ripple into other areas. Number 2, Social Security benefit taxation. I want to say this clearly because it surprises so many retirees. Your Social Security benefits are not automatically tax-free. The IRS uses a formula called combined income to determine how much of your Social Security is taxable. Combined income equals your adjusted gross income, plus any non-taxable interest, plus 50% of your annual Social Security benefits. Here are the 2026 thresholds you need to know. If you are a single filer and your combined income exceeds $25,000, up to 50% of your Social Security benefits may become taxable. If your combined income exceeds $34,000, up to 85% may be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Now here is what makes this so dangerous for retirees. Those thresholds were set in 1983 and 1993. They have never, not once, been adjusted for inflation. That means every year, as benefit amounts rise with the cost of living, more retirees cross those thresholds and owe taxes they never expected. And when you add an IRA withdrawal, like Robert did, it pushes your combined income even higher. Social Security that was previously exempt can suddenly become taxable in the same year. Number 3, Medicare IRMAA premium adjustments. This is the one that blindsides retirees the most. Most people assume Medicare premiums are fixed, the same for everyone. They are not. Medicare Part B and Part D premiums are adjusted based on your income. This system is called IRMAA, the Income-Related Monthly Adjustment Amount. In 2026, the standard Medicare Part B premium is approximately $204.40 per month. But if your income exceeds certain thresholds, your premium increases significantly. At the highest income tier, the Medicare Part B premium reaches approximately $443.90 per month. That is more than double the standard amount. Here is the part that catches retirees completely off guard. Medicare does not use your current year income to set your premiums. It uses your income from 2 years ago. So if you take a large IRA withdrawal this year, in 2026, that income will affect your Medicare premiums in 2028. You may have already spent that money. The furnace is fixed. The medical bills are paid. But 2 years later, your monthly Medicare bill goes up and stays up for an entire year. The IRMAA threshold for single filers begins at $103,000 of modified adjusted gross income. For married couples filing jointly, it begins at $206,000. Number 4, Retirement Account Withdrawal Tax Treatment. Before retirement, most of your income came from wages. After retirement, it comes from account distributions, and the tax treatment is very different. Withdrawals from traditional IRAs, 401ks, and most pensions are taxed as ordinary income in the year you receive them. This means a large withdrawal in December can push you into a higher tax bracket for that entire year. Roth IRA withdrawals, on the other hand, are completely tax-free. as long as the account has been open for at least 5 years and you are at least 59.5 years old. One more critical rule. If you withdraw from a retirement account before age 59.5, you face 2 penalties: full ordinary income tax on the entire amount, plus an additional 10% early withdrawal penalty. This catches younger retirees who retire in their mid to late 50s off guard more often than you might think. Number 5. The Social Security Earnings Test. This one applies specifically to retirees who claimed Social Security before their full retirement age and who continue to work. If you are collecting Social Security before reaching your full retirement age and you are still earning income from work, the SSA applies what is called the earnings test. In 2026, if you earn more than $24,280 per year, the SSA will withhold $1 of your Social Security benefit for every $2 you earn above that limit. In the calendar year you reach your full retirement age, the limit increases to $65,280, and the withholding rate drops to $1 for every $3 over the limit. But here is the good news, and it is genuinely good news. Once you reach full retirement age, the earnings test disappears completely. There is no limit. You can earn as much as you want with no reduction in benefits. And here is something even more important. The benefits that were withheld during those earlier years are not permanently lost. When you reach full retirement age, the SSA automatically recalculates your monthly benefit to give you credit for every month your benefits were withheld. Your monthly payment goes up, permanently, to reflect that. Now, before I give you your action plan, I need to tell you about the most dangerous trap hidden inside everything I just explained. It is the one Robert fell into. It is called the cascading effect. Most retirees think of these 5 rules as separate things. Separate boxes, separate problems. They are not. They are connected, and one single financial decision, one large IRA withdrawal, one missed RMD, one unplanned distribution, can trigger all 5 at once. A large IRA withdrawal increases your taxable income. That pushes more of your Social Security benefits into taxable territory. It can move you into a higher federal tax bracket. 2 years later, it raises your Medicare premiums. And if you delayed your first RMD and are now forced to take 2 in the same year, every one of those effects is doubled. This is the cascading effect, and it is almost never explained to retirees in advance. But now you know. Let me give you 3 steps you can take right now to protect yourself from everything I just described. Step 1. Find out your RMD age and calculate your first withdrawal deadline, today. Do not assume you know when your RMDs begin. The law changed under Secure 2.0. If you turned 72 after December 31, 2022, your RMD age is 73, not 72. If you were born in 1960 or later, your RMD age is 75. Go to irs.gov and search for required minimum distributions. The IRS has a calculator and the official Uniform Lifetime Table available for free. Write down your deadline. Mark it on your calendar. Do not miss it. And here is a critical warning about your very first RMD. You are allowed to delay your first RMD until April 1st of the following year. That sounds helpful, but if you do that, you will be required to take 2 RMDs in that second year. One for the prior year and one for the current year. 2 RMDs in one calendar year almost always triggers every single problem I described: higher tax bracket, more Social Security taxation, and IRMAA premium increases 2 years later. Unless you have a very specific reason to delay, take your first RMD in the year you are required to, not the year after. Step 2. Check whether a large withdrawal will trigger IRMAA before you take it. Before you take any large IRA withdrawal or make any financial decision that significantly increases your income in a single year, ask yourself this question: will this push my modified adjusted gross income above $103,000 as a single filer or $206,000 as a married couple? If the answer is yes, or even maybe, you need to plan carefully. If your income has already dropped due to retirement, divorce, loss of a spouse, or another qualifying life event, you have the right to appeal your Medicare premiums. You do this by filing SSA Form SSA 44 directly with the Social Security Administration. This form asks Medicare to use your current, lower income rather than your income from 2 years ago. Many retirees do not know this form exists. Many who do know about it never file it, and they overpay their Medicare premiums for years as a result. Visit ssa.gov and search for Form SSA 44. Download it. If your income has dropped significantly, file it. Step 3. Get free, expert help from AARP Tax-Aide before the end of this year. I want to say this as directly as I can. The interaction between RMDs, Social Security taxation, Medicare, IRMAA, and account withdrawals is genuinely complex. You should not have to navigate this alone. AARP Tax-Aide provides completely free federal and state tax preparation for all seniors age 60 and older. Their counselors are trained specifically on RMD rules, Social Security taxation, and Medicare premium planning. They can look at your specific situation, your income, your account balances, your benefit amounts, and help you make decisions that minimize your tax burden and protect your Medicare premiums. It is free, it is professional, and it is specifically designed for people in your situation. Visit aarp.org and search for Tax-Aide to find a location near you. Do not wait until April. Go before the end of the year, while there is still time to make decisions that affect your tax liability for this year. Before I go, I want to take just a moment to be honest with you. I have been doing this work for a long time, and the thing that bothers me most is not the complicated rules. It is the fact that nobody tells retirees about these rules until after something goes wrong. Robert is not unusual. Robert is the norm. Hundreds of thousands of retirees are making financial decisions right now, IRA withdrawals, Social Security claims, Medicare enrollments, without knowing how these 5 rules interact. And they will not find out until they open an unexpected tax bill, or see their Medicare premium jump, or receive a penalty notice from the IRS. You now know what Robert did not know, and that knowledge is worth protecting. Now, I want to say something about YouTube specifically. YouTube notifications are unreliable. I have heard from many of you that you subscribed to this channel months ago and never received an alert when we posted something critical. That means you could miss a rule change, a new RMD deadline, a Medicare threshold update, a Social Security policy shift that directly affects your money. That is why I want to personally invite you to join our Global Senior Alerts official WhatsApp channel. The link is in the description below this video. When you join, you will receive real-time alerts about Social Security rules, IRS policy changes, Medicare updates, pension regulations, bank rules, and travel requirements, delivered directly to your phone. You will also be able to download our free Senior Benefits Protection Guide. This is a complete plain language reference that covers everything I talked about today. RMDs, Social Security taxation, Medicare IRMAA, retirement account rules, and the earnings test, all in one place, written in language that is easy to understand and easy to use. Print it out, keep it on your table, share it with someone you love who is retired or approaching retirement. Because the 5 rules I described today are not going away, but the damage they cause, the surprise tax bills, the inflated Medicare premiums, the missed RMD penalties, is completely preventable with the right information at the right time. My name is Faria. Thank you for spending this time with me today. I will see you in the next video, and until then, know your rules, protect your income, and please, take care of yourself.